Hello, everybody, and welcome to Hash Rate. My name is Mark Jeffrey. My guest today is Rafael Cosman of TrustToken. But first, a shout out to crypto exchange MEXC. Use my link in the YouTube show notes. Get up to $4,100 bonus. MEXC has the widest selection of coins, 1,533 pairs. More than anyone, I'm pretty sure. Anyway, MEXC, I love it. Join today. Use our sign-up code. Get the $4,100. So hello, Rafael, and welcome to the show.
Hello, Mark. Great to be on. Thank you.
So let's dive right in. What is TrueFi? Tell us about TrueFi and the TrustToken.
Absolutely. So our company is called TrustToken. We're the makers of the TrueFi lending protocol. It is a large DeFi protocol that just passed, I believe, $1.7 billion of loans originated directly on the blockchain. And the thing that is innovative about TrueFi is it really introduced the idea of doing uncollateralized lending on chain. So
yeah, which is let me frame that a little bit because a lot of people might not know this. So most of DeFi, decentralized finance, the way it works is you go to a site like Aave, for example, which is collateralized lending, and you show up with some other token, and you basically put in 1.5x whatever you want to borrow. So if you want to borrow $100, you got to show up with $150 of whatever other token. And then if that token crashes in value, they'll liquidate you, right? If it crashes below some level that they determine is the safe level of your loan. So you are now saying, okay, we don't require collateral. You don't have to put in the $150, right?
Exactly. Now I will say that's a great explanation of the difference between these over-collateralized lending protocols like Compound, Aave, and Maker that were very important for growing this first wave of DeFi, but there's a second wave now with somewhat more sophisticated protocols like ours that are doing and under collateralized lending. I will say that our protocol and most other lending protocols that allow under collateralization or uncollateralized loans do not loan to consumers. So it's not like someone can just get a $100 loan from TrueFi. Our protocol is very focused on lending, B2B lending to institutions, to businesses that are putting that capital work. That's for a variety of reasons. Consumer lending is a whole can of worms from a regulatory perspective, from a collections perspective, a lot more difficult. But within B2B lending, which is the sector that TrueFi is focusing on, it's had a tremendous amount of success. And what we're really excited about is we think that these more general lending protocols like TrueFi have the potential to become protocols that power a huge amount of how lending works globally. That's where we think DeFi is going. We think that there's trillions of dollars that is right now moving around the world on very antiquated rails, and where DeFi has a tremendous amount to offer.
Yes, and so you also have some incredible backers. I went and looked at your website. So you've got Andreessen Horowitz, the A16Z, Alameda, Blocktower, and Founders Fund. I mean, that is just A+ list of backers. So how did you get those guys? And tell me a little bit about that.
Well, we talked to them. We told them what we were doing. But I think we've been around for a while. The company was started in 2015, at the end of 2015. We launched.
Oh wow, I didn't realize it was that old. Interesting. Is. Okay. And I mean that's good. I mean old in a good way, not in oh my god you're old. It means you got experience. I love that. So,
we do. Yeah, we've been around the block. Survived multiple summers and winters. And we launched TrueUSD, our first major crypto product, in 2017. That is now a $1 billion fiat-backed stablecoin, and it really pioneered what a modern fiat-backed stablecoin looks like and inspired a lot of the other stablecoins that came afterwards. And then launched TrueFi in 2020. And so we've got a strong track record, we've got a great team, and something that we've demonstrated to the market and to our investors is that we can do really good work at this very interesting intersection between DeFi and TradFi, which is not a place that a lot of people know how to play, but that really is part of our company's DNA from the beginning. There are some teams out there where it could be, pure technical team just building a super optimized L1 that's going to go beat all the other L1 blockchains, right? And that's great work. I love that that's happening, but that isn't where our team tends to shine. We do have an extremely strong technical team, but we complement that by being very strong on the legal side, the regulatory side, the operational side, everything that you need to be able to do stuff that bridges between DeFi and TradFi. And that's where we think some of the most interesting opportunities, like stablecoins, like uncollateralized lending with TrueFi, and like many more in the future, that's where we think some of the most interesting opportunities lie.
Okay, so let's talk about how you do your lending a little bit more. So on your website, it says, currently we only allow institutional borrowers with at least 10 million in net unencumbered assets to borrow on the TrueFi platform. And there is a credit check, so very sort of TradFi. And then on the lending side, only whitelisted lenders can lend. So DeFi, decentralized finance, in a lot of ways, to date, has been sort of the very definition of progressiveness and equity incarnate, in the sense that it allows average citizens to have micro ownership of lending, bridging, and exchanges, and make fees like a bank, like an exchange. And people, like Elizabeth Warren, they should love that vision, right? Because it accomplishes with capitalism what they want to do for social equity, right? So what you guys are doing is, it seems in some ways to be the antithesis of broader DeFi and sort of go against that vision. What do you think about that?
It's a good question. I wouldn't say that we go against the broader vision of DeFi. I would say that the vision of DeFi is evolving to fit the modern regulatory regime that's coming out, and also the needs of institutions that are looking to deploy millions or sometimes even billions of dollars into these kinds of protocols. So with TrueFi as an example, we do have some lending portfolios that are completely open to any lender that wants to come in. We have some lending portfolios that require KYC. We have some that disallow US lenders for legal and regulatory reasons. And we see the protocol as being a general piece of open source software that lots of different portfolio managers can use to launch and run lending portfolios on the blockchain. And they can set different restrictions for those lending portfolios depending on their jurisdiction, depending on how they're regulated. Are they a broker dealer? Are they not a broker dealer? Are they inside the U.S., outside the U.S.? What asset are they offering? Are they doing loans more or less than a year? There's a whole bunch of different things that go into the analysis of who they might want to allow as lenders and as borrowers. Now, borrowers are almost always going to need to be fully KYC'd. You have to be very careful who you lend to, of course. But with lenders, there's various levels of restrictions really depending on the portfolio manager and depending on the needs of the borrowers. Does that make sense?
It does.
That's still, from our perspective, that doesn't change the fact that the protocol is fundamentally open. The fundamentally open protocol that allows portfolio managers to launch a variety of different portfolios with different characteristics. Just like how Ethereum is a totally open blockchain, and you can launch different tokens that have different characteristics and different restrictions on the token. That doesn't make Ethereum fundamentally a closed platform. It's the same thing with TrueFi, that the platform we see is fundamentally open, but the individual portfolios have different restrictions for regulatory reasons. And that is part of what allows, our goal is not just to build a really cool thing. Of course, that's important too. But, we want it to be accessible and to be usable by TradFi institutions that are increasingly interested in deploying capital in this space, and that we're having very, very good conversations with. And many of them care about, hey, if I'm borrowing, what do I know about the lenders that are putting money in? Or if I'm lending, what do I know about the borrowers who are taking money out? They care about those things for reputational reasons and for marketing reasons and for regulatory reasons. And we have to make sure that we are, able to make the best possible offering.
Yeah, that makes sense. I mean, we're definitely entering an era now where DeFi is going to be sort of less wild and crazy, and anybody and everything. We could be borrowing from North Korea, that's bad, right? We definitely don't want to live in a world where that's possible.
Right.
On the other hand, we want to live in a world where the average person's got a shot, and there's, it's free and open to most people on Earth, and it helps most people on Earth. So, but we do have to pay attention to both sides of that equation for sure.
Exactly.
So
And that's something that we're always working on in all of our products. Like with TrueUSD as well, we do KYC every single person that purchases or redeems a TrueUSD for fiat currency. And we can look on the blockchain and see if there are sketchy things that are going on, because we certainly don't want any of our products to be used by malicious actors or for bad purposes. So while some of these platforms, there is that important level of openness, you can't necessarily completely control what all these systems are used for, but we do put a lot of protections in place to make sure that they are as compliant as they possibly can be.
So talk to me a little bit now about the actual rates. So your website says you can, if you're a lender, you can put in USDC and make 12% APY. And that's compared against far lower APYs on things like Aave and Compound, which are sort of sub 1% APYs at the moment. Is that a stable API, or is that sort of tend to range around a lot?
It's not a stable APY. It does go up and down. Let me actually take a minute to project and show what TrueFi looks like today. So this is the actual application, app.truefi.io. Anyone can go and visit this app and actually start using it today. It's been live for almost 2 years now. Originated, as I mentioned, just over $1.7 billion of loans, all directly on the blockchain. You can see all those loans going out, coming back. In terms of portfolios that we have available today, here are some of our largest portfolios. We support 4 different stablecoins: TrueUSD, Tether, USDC, BUSD. You can see a range of different rates here from about 9 to 12%. We have a whole bunch of different strategies. Some of these major portfolios are focused on lending to crypto market makers and trading firms. That's where a lot of our lending has been so far in the past year or two. But we do a bunch of strategies that are focused on areas beyond that. That include partnerships with other protocols. For example, this portfolio with Woo Network. Woo is another great protocol that we're working with. It lends to various participants inside of the Woo ecosystem that's actually denominated in their native token Woo. So that's an interesting portfolio we launched recently. We've got one called USDC.Homes, which actually lends against real estate. We've got some that are focused on neofi or fintech opportunities. This one, Karis, is actually focused on fintech in emerging markets. Karis is they're a portfolio manager that knows that area really well and is very, very confident in their ability to deploy capital there. And we also have single borrower portfolios, which just lend to a single well-known borrower like this one with Alameda. So a whole range of different offerings. Yeah. And
so let me stop you there, because I want to make sure I'm understanding this and everyone else does as well. So part of what you provide, or maybe this is the main goal here, is the infrastructure for someone else to create a lending platform and their own rules for providing the loans. And what we're looking at right now are all these other people which have created their own lending platforms using your infrastructure. Am I getting that right?
That's right. We call them portfolios. So it's still all on the TrueFi platform. It's part of the TrueFi protocol, but it's different portfolios that are managed by different people. And let's say that you were an expert in lending to small businesses in Mexico. Then you could launch a portfolio that focuses on that and say, hey, I want to raise $5 million that I'm going to lend out to 100 different small businesses in Mexico. And you could launch that portfolio on TrueFi and use our protocol, use our platform to raise that capital, but still it goes into your specific lending strategy. And we would have lenders on the platform who are excited about the lending strategy that you can provide, which might not be something that they have access to in any other way.
So what happens if my lending portfolio has a bunch of deadbeats in it? What if I thought I was an expert in Mexico and it turns out I'm really not? What happens to? Do I just go under? Like, it doesn't affect the broader ecosystem. It's just me, right? Pretty much is what happens. I go down and that's it.
So yeah, you would go down. So it's an important question for us. We do try to be very careful about which portfolio managers we work with, because we do want to have high quality portfolio managers on the protocol, but also we do want the protocol to be open and to let all kinds of different portfolio managers in. And sometimes those portfolio managers may have weird strategies that we don't 100% understand, but they might still be very interesting to some lenders. And there's no question that there's going to be a mix. Some are going to perform really well. Some of them may have some issues. And that is, of course, just part of a lending business. But the way we see it is that we want the core protocol to be very open, but we can still have some walled gardens within that, where we say, okay, here are some highly vetted portfolio managers that we know are, really institutional grade managers that you should feel very confident in, that we've vetted, that other institutions have vetted, and so on. Versus, okay, well, here's, there may also be an opportunity to say, hey, well, this is more like the Wild West, where you can go see all kinds of opportunities, but these aren't vetted. They don't have, think of it like the little blue check mark on Twitter. They don't have anyone who's vouching for them. They're on the protocol. They're using the protocol to raise capital, but at the end of the day, it's really up to you whether you read their description, you look up their website, you may know them and you think that they're legit and want to deploy some capital with them.
Okay, makes sense. Did you have more stuff you wanted to show us on the product, or do you want to continue on other questions?
No, I guess I just wanted to show briefly, part of why we think the whole uncollateralized space is exciting is, just as you mentioned, Mark, we do have a whole variety of things on the protocol. Anything from, I'd say, 7 to 12% available right now, depending on the strategy. Some more aggressive could be lending money to crypto market makers, crypto firms that are doing trading. Some of them more conservative, lending to real estate. Some folks lending to fintechs, a whole variety of different strategies. But if we compare that against other opportunities in DeFi, a lot of things in DeFi, like Compound and Aave that we mentioned, that are doing over-collateralized lending, they might only be yielding something like 1%, sometimes even less. Okay. And that is part of the issue, is that those protocols, they do have this layer of security, because, as you mentioned, you have to put up, let's say, $1.50 of Ether to borrow $1 of stablecoin, or put up $1 of stablecoin, $1.50 of stablecoin to borrow $1 of Ether. That does add some security for the protocol and for lenders that are providing that capital, but also you get a vastly lower rate, because no one's willing to pay nearly as much for a loan if they have to put up 150% collateral. I mean, why would they? And so there are two different points along the risk return curve. We think that both make sense, but at the end of the day, especially if you look at TradFi markets, the market for doing this kind of over collateralized lending, which is essentially like margin lending, the market for that is actually very small. It's still a decent market, it's easily in the billions, but it's still very small compared to the entire world of lending, which takes into account a lot more than just that $1.50 of collateral that you have. It takes into account, all of your creditworthiness and your revenue and all kinds of other factors. And that is the kind of more sophisticated protocol that we are working on building, and that we think can really change how finance works. So that's what we're excited about it.
My next question was actually going to be, talking about the 12% to 17%. How you doing that? Where's the magic coming from? And your answer seems to be, well, there is, people are willing to pay premium rates for uncollateralized loans, and that's why it's so much higher. Is that correct?
That is correct. And you can actually, because this is DeFi, one of the things that's exciting about DeFi is you can just inspect the protocol yourself. You can literally go see every single loan that the protocol has out. You can see every single loan that it's made since the protocol launched, something like 23 months ago, November 2020. If you just go to our analytics page, app.truefi.io/loans, you can literally see it right here. Here $10 million, just got repaid by Folkvang. Here's $20 million by Nibio. You can see all of these repayments. You can see any loans that were amended or renegotiated between lenders and borrowers. All the history is there. So not only can we provide very attractive, what we think are very attractive risk-adjusted returns for lenders that are excited about this kind of opportunity, which is of course one of our main goals, but also a level of transparency that is unparalleled in TradFi. So even though lending is always going to have risk, you're always putting money at risk if you're using a protocol like this, unlike with CeFi lenders or with many places in TradFi, there's just a level of transparency here where you can see very clearly what's happening with your capital, and you know exactly what risks you're being exposed to.
That is super cool. So, so you also, your funds, so first of all, you guys have had no defaults to date. Is that correct? I think I read that somewhere. So you're zero defaults at the moment.
That's right. We are still at zero defaults today. 1.71 billion lent out. I think we've had 1.47 billion already repaid successfully, with $34.2 million of interest, which we're very proud of. And most of that interest goes directly back to the lenders who are putting their capital at risk. Some of it, a small piece of it, goes to the protocol itself to help grow the protocol, to help bring more value to the TRU token, which governs the protocol. But most of that goes back directly to the lenders, which we love, and that's also part of what's great about DeFi, that transparency, that value alignment between lenders and the protocol. But of course, there is no lending business without defaults. It's going to happen at some point. We did actually recently announce our first renegotiation of a loan, which was publicly announced on our Twitter. So there's no lending business without some default. It's going to happen at some point, and the question is just, can we have a platform with a lot of high quality portfolio managers, where those portfolios will, over time, have an attractive risk-adjusted return, even when taking into account the inevitable default rate. That's what we're focused on. So there will, of course, be defaults at some point, but we just want to make sure, as much as possible, that it's still an attractive product, even taking that into account.
Yeah, I think after the the utter destruction fest that was the first half of 2022, people are now thinking, okay, what's the worst case scenario? How can this go wrong? And what happens if it does? Because now we've seen it go wrong at very large scale for things that I think a lot of people thought were pretty safe. So one of the things that you guys talk about, you have SAFU, so Secure Asset Fund for Users, which is, my understanding of that is it's sort of like an FDIC. It's not FDIC, just to be very clear, because that's been a thing recently as well. But it's sort of like that, and it's a rainy day fund for when things go wrong. And I used to see CZ always talk about funds are SAFU, and I remember I didn't know what that meant, and I always thought it just meant funds are safe as fuck. I honestly thought that was like the DeFi, some DeFi slang that I didn't know yet. And then I went and looked it up. I was like, oh, okay, I see what this is now. So tell me a little bit about what that is on your end and how that helps protect everyone.
So some of our portfolios do have some additional protection from a SAFU, which holds some TRU tokens and can liquidate those and provide some capital to be recovered by lenders in the event of a default. And some of those portfolios are also protected by a staking system where TRU holders can stake their TRU and will also have some of their TRU liquidated in the event of a default, and that can help to protect lenders. But that isn't all of our portfolios. Some of them do not have those protections. And really the primary protection for all portfolios is that there are solid legal agreements in place between every portfolio manager and the borrowers that they're lending to, and they can recover hopefully some of those funds in the event of a default through the normal collections and legal proceedings that would happen in anywhere in TradFi as well if someone defaulted on the loan. So that is a place, in terms of collections, in terms of recovery and underwriting, that's a place where TradFi has developed those things really well, and we don't have any major innovations that we're bringing at this time. It's the core lending system. It's the core protocol for doing the lending that we see as significantly better than the way that TradFi works. And so, it's a combination of adopting things that we think are, already doing okay from TradFi, or at least are, as good as we know how to make them, and then some, bringing in DeFi and some just much better financial technology for being able to move money around, for being able to raise and deploy capital, and overall ending up with a much more efficient system.
Yeah, I was thinking about this question before we went on today. And, we talked earlier about how you all are B2B, you are vetting both the lenders and the borrowers. And in some cases, it's a lot more centralized. So why use tokens? Why use blockchain? And I think your answer is enhanced. Well, first of all, everything just moves faster because you don't have to deal with the antiquated, banking system and wires and borders and all that stuff. It just whirls around the world at light speed, and it does what it does because it's crypto. But also because of the enhanced transparency. Everybody can see everything all the time. You're in a state of open, perpetual audit. Are there any other advantages, or is that basically it?
Those are the main ones. And, it's easy for those to seem small until you actually go and run one of these processes with a bank. So, there's this joke on Twitter that, you go to the bank to send a normal bank wire, right? The simplest thing you could possibly do with US dollars. I just want to send $100 from me to you using a bank. Should be easy, right? You go to the bank to send a bank wire. You realize how unbelievably miserable it is. You come home and the first thing you want to do is buy more Bitcoin, right? And the reason is because these systems are really crappy. If I tried to send you a bank wire right now, heck, banks are almost closed on the East Coast already. It probably wouldn't get there until tomorrow morning at the earliest. If it's an international wire, it's going to be more like 3 to 5 business days. These very simple fundamental operations with fiat currencies are extremely slow and painful. And if you think about what we are capable of with the internet today, look at something like Facebook or Google, right? If Google didn't work on evenings or weekends, if Facebook didn't work on evenings or weekends, people would be rioting. They would be going crazy about it. But which is more important to how our country and how the global financial system works? Facebook or the US Fedwire system, which moves literally trillions of dollars and is the bedrock of global trade? So the fact that one of those is, how often do you log into Facebook and Facebook is down?
Never.
It's never. It's almost
pretty much
100% uptime, right? It's hard to remember the last time Facebook was just down. Whereas the Fedwire system, we just accept its uptime is what, like 30%, 9 to 5 Eastern time, 5 days
totally.
a week. We just accept this unbelievably poor service. And look, I'm not blaming them. I understand that it is that way for a certain reason. There's a lot of manual processes. It was built a long time ago. These things are very difficult to change. But those are just the fundamentals of how our system works. And then if you talk about, sending money, that's probably the simplest thing that you ever do with our financial system, unfortunately. If you want to go up from that, now let's say you want to get a loan. Well, have you ever gotten a loan from a bank, Mark? Because...
yeah, it's absurd. Everything about our financial system is insane. It's pre-AOL. Right, that's sort of, it's 1970s technology. It's ridiculous, no question about it. And processes,
right? So there's some sense in which what we're doing, it's not that mind blowing. We are just doing very simple stuff. Being able to send money, like what we did with TrueUSD, making a fiat-backed stablecoin, being able to lend money, what we're doing with TrueFi. These are very simple, very primitive operations. And it's not. They aren't that complex things. Like lending, it's like, you have a portfolio manager who manages a portfolio of loans and is underwriting. You have lenders that lend capital into the portfolio. You have borrowers that get approved and then can borrow out. They repay, goes back. In some sense, it's not that brilliant, but we're just doing it using the modern technology. We're just building it the way if in the year 2022, you were to invent these simple things. We need to send money. We need to lend money. We need to do these other basic operations. How would you do them given that we have the internet, given that we have cryptography? We have these decentralized technologies. There's just a certain way that you do it, and that's just what we're doing. And it is just fundamentally so much more efficient, and we're getting a very positive response from the market on that, where people say, okay, so I'm a trading firm and I need to send Mark $1 million because we just did a trade, right? Well, I could use
Yeah.
the normal fiat system and I could wait for 24, 48 hours, and time is money and I'm just losing money during that time. Or I could send stablecoin and 15 seconds later it's in his wallet, right? It's like
Yeah,
a
it's
text
just
message or an email. It's how it should work. Same thing with lending, right? I could go get a loan with a bank. If you're so we have some fintechs that we work with in emerging markets that have tons of difficulty getting any access to capital, even though they're phenomenal businesses. You could go to a bank, you could struggle a ton. It could take weeks or sometimes even months to get anything done. Whereas TrueFi, I mean, a portfolio manager clicks a button, 15 seconds later, the money's there, right?
it's hard to overestimate how powerful, very simple, don't overthink it, ideas at this moment in history are that simply do traditional things well and incredibly legally well crafted, but just use the crypto rails, and that's it. And don't do any more than that. Don't get crazy. Don't really even innovate that much. That alone, the crypto is the innovation. Don't mess with anything else. That alone is extremely powerful.
Exactly. And at some level, DeFi is pretty simple. I mean, if you go and look into the details of how the Ethereum blockchain achieves consensus, how the cryptography works, and so on, there are a lot of really beautiful, really elegant details in there that are worth studying, and we could talk for hours about. But at some level, it's pretty simple stuff. And at some level, the thing that is truly complicated is the way that TradFi works, and we're doing it so much more simply. If you look under the hood, like let's say stocks, right? If I have one share of Google stock and I want to give my one share to you, if you look under the hood at what needs to happen to make that very simple thing happen, just one share moving from me to you, and you look at the number of brokers and dealers and clearing houses and the DTCC and the number of different actors that are involved in this very, very simple transaction, it is amazing. And in the crypto world, that's just a token moving from one address to another. It's super simple and super straightforward. So that is that's really the core of what we're doing, is just a simpler, more transparent, more open way to do finance.
Now, you're on Ethereum. Are you on any other chains, or is it just Ethereum right now?
We recently launched on Optimism, which was a very big moment for us. Optimism is an Ethereum L2, and so it still gets a pretty high level of security, maybe not the full level of security of a strong layer 1 like Ethereum, but it has way lower gas fees. And so that actually opens up our protocol for smaller lenders and borrowers. Someone who wants to only put, let's say, $100 into a portfolio, they may be hesitant to, if it's a high gas day and they have to pay, $1 or $2 of gas, that could be significant if you're a small lender or a small borrower. But doing that on an L2 could make a lot more sense. So we're both on Ethereum L1, Optimism, the L2, and in the future we may add other L1s and other L2s if we see demand for lending and borrowing there.
Got it. Okay, so let's talk a little bit about the TrueToken. So why do I want to own TRU? And I think the answer is you stake it to earn, at the moment, 100% of the protocol fees, which are defined as 10% of the loan interest. Is that correct? And is there more to it than that?
So there's a bit more to it than that. So first of all, let me just say nothing on the show is investment advice. Absolutely do your own research and consult your own advisor, whether it comes to buying the TRU token or interacting with TrueFi or any other protocol in any way. But the TRU token, it is the governance token of the TrueFi protocol. And you can stake it on the protocol, as you mentioned. And right now, there's actually very healthy discussion going on in our community right now about what the future tokenomics should be. And part of what's exciting about having a DeFi protocol is that TRU holders ultimately govern the protocol and can decide how they want to design the so-called tokenomics of that token. But right now, you can stake the TRU token on the protocol, and you get paid out in TRU. Right now, it's about 20% APY, which is pretty attractive.
Wow.
Now, because you're staking, you do have, if a loan from one of our 4 main DAO portfolios defaults, you can have up to 10% of your staked TRU liquidated per default to cover that loss for lenders. So you are taking some risk, but on the other hand, you're getting paid some significant reward. And so owning TRU may make sense if you think that that is an attractive option.
Yeah, so basically it's a bet on the very conservative and very sort of well-considered and well-vetted system that you have set up. So that's really what you're betting on, and of course there's going to be some defaults, but it's a pretty good bet. Yeah, definitely a better bet than a lot of things in DeFi at the moment, for sure.
Yeah, so definitely not investment advice. Need to do your own analysis, but yes, that the bet is on the success of the protocol, on the success of those lending portfolios, and long term, if it's a community governed protocol, TRU holders actually vote on major proposals on chain. They do an on chain vote. They actually own the smart contracts, and they get to vote for what they want the future of the protocol to be, how they want to upgrade the protocol, what changes they want to put into effect. And so at the end of the day, if TRU holders govern the protocol well and help it to grow and help it to succeed, then that may make TRU more valuable. So that's, anytime you participate in a DeFi protocol, that's part of the responsibility and a part of the reward.
Totally get it. Okay, one last question before we go, because we're coming up on the 40-minute mark here. So I've been shadowing all of Andreessen Horowitz's investments over the last, 3 or 4 months or so.
Yeah.
And I've noticed what I think is a pattern, and I want you to comment on it. Yeah, so the pattern is basically this. There's a lot of really awesome stuff in wild DeFi, but it's kind of crazy and kind of too insane. So the pattern is take wild DeFi, put some conservative guardrails around it in some way, right? And just it's everything is some version of what you've already seen in wild DeFi, but in a suit and tie. Right, so to speak, right? And so there was one company I was looking at, and I'm not going to say which one it is, but I was reading about it, and there was a moment where I said, wait, this is basically just Wonderland in time, but instead of Danny and Sifu's face on the door, it's Mark Andreessen's, right? And they've actually thought it through better, so it's a lot safer. But pretty much that's what I saw. Do you think my impression is correct or not?
So, Mark, I think there's a lot of truth to that. And I do think that even so-called wild DeFi is mostly realizing that it needs to make that adjustment and, if not put on the suit and tie, at least create the layer, the interface layer, such that more traditional institutions can use these protocols. So just as some examples, Compound, which has been a very well-respected DeFi protocol for a very long time. They launched Compound Treasury, which is a company and a service that allows more traditional folks to be able to, put capital in the Compound Treasury, earn an attractive yield, and not have to directly use MetaMask or anything like that. Aave launched Aave Arc, which includes some more permissioned institutional-style portfolios that are part of the Aave protocol. TrueFi, similarly, we're organized. We have a DAO and we have the protocol, which is decentralized, but we also have our company TrustToken, which is focused on building a lot of that institutional layer on top of the core open source technology, such that institutions can use it. I think that we actually see an analogy to a lot of what's happening, a lot of what DeFi is realizing, and what Andreessen, I think, has known for a while. We see a good analogy in Web 2.0 companies, like if you think about, let's say, MongoDB, right? They have the open source technology, the Mongo database, which is, for folks that haven't heard of it, it's one of the most widely used databases in the world, along with some other major open source ones, Postgres and so on. But many of these things, there's an open source technology like MongoDB, and then there's a company that builds, a hosted solution and a bunch of software and services around this core piece of open source technology. And if you're just an indie developer getting started, trying things out, you might just go for the open source technology, and that's fine. But if you're a more established institution, you have a lot of capital, a lot of users, a large team, and so on, you're not necessarily going to just grab the open source thing off the shelf. You're going to want a lot more than that, right? You want permissioning, you want regulatory stuff, you want legal stuff, you want contracts in place. There's a lot of things that you want that go beyond just the piece of open source technology. And so that's how we organize ourselves into decentralized protocol and DAO and centralized company that builds important services and software on top of that and is a part of the ecosystem but doesn't own that core protocol. And we see many other smart companies doing similar things. And there are companies that, as you said, are doing like pure DeFi, everything's decentralized, there's no centralized services, there's no centralized legal structure, there's none of that. We do see companies that are doing that, but we think that many of them will limit their success unless they are paired with a company that's building that interface layer that can allow more traditional institutions to come and utilize that technology. That's how we see the breakdown. And I can't speak for Andreessen. Of course, we're just a portfolio company, but I do think that they're seeing some of the same things in the market that we are.
I agree, and thank you for that. Well, our time is up, Rafael, but this has been fascinating. Thank you so much for coming on the show. Where can people find you? What websites, what Twitter handles? Where can the people find you?
So you can find me personally on Twitter at Rafael Cosman, RafaelCosman. And you can find our company, our DAO is at TrueFi DAO, TrueFi DAO. And we actually have all the links to our Twitter, our Discord, everything are on the website, TrueFi.io. That's TrueFi.io. We would love to have you all come and work with our community, get involved in the protocol. Part of what's exciting about DeFi is this isn't just like, hey, here's a thing we've built, do you like it? This is really a community-driven effort. Even the name TrueFi actually was proposed by a community member. And so the next great ideas for what we need to do in lending, what kinds of portfolios we should be launching, what kinds of strategies we should be using, how we should be improving or optimizing our token, all these kinds of things oftentimes come directly from the community. So we would love to have you come and engage and use the product and let us know what you think.
Alrighty. Well, this has been Hash Rate. My name is Mark Jeffrey, and we'll see you all next time.
Thank you, Mark.